Hello, everybody, and welcome back to Larry's Anything Goes. I hope you guys are having a great weekend. I just wanted to put this little video out before we get into the actual video. I'm going to be talking about 401ks, individual retirement accounts known as IRAs, stocks, bonds, and real estate investments. And I just wanted to put a little disclaimer out there and say thank you to everybody who's liked my page, whether it's on Facebook, Twitter, YouTube, the whole nine. Thank you for those who have shared my videos. I greatly appreciate it, and we can actually get this financial intelligence movement started and continuously grow it and explore it all over the world. So not only can we have better daily lives, but we can have a better retirement when we get older, and we can make life easier on our friends and families, loved ones, and the whole nine. So I hope you guys enjoy the video, and please continue your support, and please continue with the positive feedback. Thank you, and take it easy. Hello all, and welcome back to Larry's Anything Goes. Hope you guys are having a great day. It is nice and humid and hot here in Northern Virginia, but the show must go on, as they say, because I look at it like this: life could be so much worse, one, and two, I'm just glad it's not below zero. A lot of people love the cold. I'll take the heat any day over freezing cold temperatures. Today's discussion, we're going to get involved in stocks, bonds, my favorite subject, real estate investment, 401ks, individual retirement accounts, IRAs, the whole nine. If you have them, great. If you don't have them, after this, hopefully you'll say to yourself, well, one of those may work for me. Maybe all of them will work for me, or just a few of them will work for me. We all have options, and you should exercise those options whenever you can, because when it comes down to the money game, you got to wake up with it on your mind every day and play to win and don't play to lose. And if you're not even playing at all, then it's not a good situation. But we'll get into this discussion, starting off with stocks, because you have so many people that that are in the stock market. But then you have a lot of people that don't even want to play in the stock market because they're scared. And I say to myself, well, hey, playing the stock in the stock market, there's a better chance of return depending on how they play the game, compared to just going to the racetrack or going to a casino or just playing the lottery. And I say, hey, if you do those two things, racetrack, casinos, lottery, three things, then why not give the stock market a little bit of a shot? Because I think the stock market might even be in more of your best interest, even if you're only investing like $5 or $10 here and there, because whatever your investment, there's a risk. That's obvious. But hey, when you walk outside of your house, there's a risk. So it's not like you're not playing Russian roulette every day, because that's just the kind of world that we live in. So I'll just get into it by explaining the stock market in a very simple one-on-one terms, because this is a one-on-one video. I'm going to get in depth with more of these retirement options and investment options in later videos, but this is more of a one-on-one version of all these different items that I'm going to discuss. The stock market, you have multitude. It's usually a company that has a multitude of shares, and they usually are startup companies. There's a phase where they become successful, and then of course you have your companies that have been in the market forever since its inception. But I'm just giving a little overview. They're successful. The owners wish to expand, but they are unable to do so because they can't, solely so that they can earn through their operations, and as a result, they can turn the financial markets into even bigger investments and they can turn into those markets for additional financing. And one way to do this is the corporations, they'll end up splitting companies into more shares, and then they sell the portions of those shares on an open market, and it's a process called the initial public offering. So that's the little one-on-one aspect of stocks. And of course there's other aspects of stocks, especially when you get into the different dividend stocks and how much they pay. And always remember, when it comes to investing, you're doing it for the long run, not the short term. And if you're going to do it for the short term, then my suggestion would be is to invest as much money as you can so that you can get a greater return on your investment. Great example, I know a real estate investor who invests hundreds of dollars a month into the stock market, but he gets a great return on his investment, and a lot of times he's able to either with half of his investments actually roll that money back over into the stock market, into other stocks, and then the other half will actually take that money and put it into his real estate investment company, and he's able to buy more homes and buy more buildings, and therefore he's being in a sense penalized, but since he's putting that money back into his business, he's getting a greater tax return at the end of the day. But it's all personal preference when it comes to investing. I just put out mine and I put out others' little styles, and then obviously you as the individual have to go with what works for you at the end of the day. So now we're going to get into the bonds, because you buy stocks. I think it's in your best interest to buy bonds. They're just as cheap. The bonds that I buy, the cheapest I know is usually $30. So hey, you do $30 a month. Hey, no matter what state you live in, you're paying more on that when it comes to just filling your gas tank. So that's the time frame. That's the world we live in right now. But bonds usually fall into the category of government and corporation debts, along with other entities, and these entities raise cash so that places raise cash in places in public markets, and subsequently they pay the interest on the loan to investors. And for instance, you have $1,000 bond with a 4% coupon, would pay $20 to the investor twice a year, $40 annually until it matures. And then upon the maturity of that money, the investor usually, say for yourself, you usually get a full amount of their original principal, except for a rare occasion when a bond defaults, because like once I said, there's always that chance of you not getting your investment back, or just losing, or if you get something back, it might be a small percentage, or a lot of times it's just gone. But hey, that's the price you pay when it comes to investing. And then hey, there's do like a little compare and contrast. What's the difference between stocks and bonds? Well, one thing with stocks, since they share, since stocks represent an ownership stake in a company, meaning that the owner shares in the profits and losses of the company, someone who invests in the stock can benefit from the company that performs very well and its value increases over time. So that's the upside to it. But with stocks, they're a lot more riskier. That's another thing, because individual stocks and overall stock market tend to be riskier at the end of an investment spectrum. The volatility of it is just insane. So with that being said, the better thing about bonds is that they might lack a powerful long-term return like stocks, but they are preferred by investors for whom they have income before income is a priority, one, and then two, bonds have it's usually for a long term, because a great example, a friend of mine, she was able to pay for her daughter's college education by purchasing bonds from the day of her child's birth to the time her child was going to college. So that's 18 years worth of bonds, and it was able to pay, in today's society, her college education in full. And most college educations cost between $70,000 to $100,000, especially if you're going into a regular traditional 4-year university. So it's just something to think about, and then if you're a person that doesn't like risk, then I think investing in stocks is more, investing in bonds is more of your interest than it is investing in stocks, because there's always more of a riskier chance of you losing your money when you're investing in stocks. So something to think about. Now let's get into the 401ks. 401ks, most people are familiar with, especially given the fact that most people work for an employer, and pensions are a thing of the past, and everybody has a 401k. And a lot of people think 401ks are scams. Everybody has a different opinions of 401ks, but it's the reality you live in. So it's like I always say, you play to win, you play to lose, or you just don't play at all. It's your choice, And 401k plan is, the short of it is, it's a plan that it receives, the great thing about it receives tax advantages from all the and along with that, the money is not taxed before it goes into the investment. It's taxed after it goes into the investment. So once the money is withdrawn from your paycheck, meaning essentially the government's not going to take anything from it until it's fully invested. That's the short of it. And experts say that one should usually contribute up to 30% or more if you can, but I would imagine most people don't try to contribute more than 30% unless they can they're balling like that and they can afford that because your capital gains is taxed, and your capital gains tax is free until you decide to make withdrawals from it, and most companies put incentives out there to match employees' contributions. So great example, you put $20 down, we'll put $20 down. But a lot of times with employees, and this happened to me, they will ensure that they do their best to keep you on, because we live in an era of millennials and cloud generation where there is no such thing as loyalty. There's no loyalty from the corporation, and there's no loyalty from the employee. That's just the world we live in. And I'm not saying it's a good or bad thing. I'm just saying that's the reality of it. So with that being said, companies put stipulations on you must stay with us for between 3 to 5 years. And if you don't, then you can take your money with you if you want to, the contribution that you made to the 401k. However, we're going to keep our contributions and most likely either put it back into the company or put it in somebody else's retirement account. So say if you put in $5,000 over the 2 years that you were there and you had one more year and the company put in $5,000, it's like, well, you're going to lose $5,000 if you decide to leave us and go to this other job with a better opportunity. And a lot of people will say, well, hey, darn, I'm screwed and I need to stay, or screw it, I'll take the hit and I'll just go to this other company because there's all these great advantages over there. They're paying me more money. I'm going to learn much more. So screw it. Keep the $5,000. It's not that serious. So it's all about individual choices at the end of the day. But that's the short of it when it comes down to 401ks, and then obviously you can't withdraw from it until you're age 59 to 60, and they probably, nowadays they probably push the age up because people are living a lot longer, but this is the recent statistics from my research that I've conducted. Obviously you can do your own. Hey, if I'm wrong, I'm wrong. I'm man enough to admit that, but the money's still taxed, once you withdraw from it. But if you take the money out beforehand, a lot of times you're going to be penalized, and the IRS will tax you for taking that money out. And there's a lot of instances where they won't do that. Say if you lost your job, because it doesn't take nothing for anybody to get laid off nowadays, or if you have an illness and you can't work, and so you need that money to pay your medical bills, because medical bills are insane nowadays. So those are the instances where the IRS will not tax you. But a lot of times I found that with people, they will take that money, they'll take the tax penalty hit because they'll take that money out for a business reason. So obviously, if you're taking it out for a business reason, you're putting it into a company, you might get penalized tax from the IRS, but you're going to get a nice hefty tax write-off depending on what kind of business that you're in, and depending on what kind of profits that you've made and what kind of purchases you've made for your business. So it's something to think about if you want to start a business and you've been working for a company for a couple of years and you got a couple $1,000s that you could put into a business that could make $5,000 into $15,000 or whatever have you. Then it's something to think about, especially if you feel like that business has got great potential to grow over time. So then you pay back your loan to the 401k company who holds it. It could be Vanguard or Fidelity. There's so many companies out there nowadays. It just depends on the company that you're dealing with when it comes to 401ks. But that's an option, and it's like I said, you can be penalized depending on those specific circumstances. So something to think about. Now we'll get into one thing that a lot of entrepreneurs take advantage of, especially like myself, because I have 3 of these: individual retirement accounts, IRAs. I think they're great for people like me and the entrepreneurs of the day and tomorrow, because if you're your own business, for the most part, you don't have a 401k unless you're still working a job. So you're not putting money away on a monthly basis and getting some sort of a percentage and some sort of a match, because all the IRA is just it's an individual version of a 401k. The only difference is you're getting your money's still being invested, and you're still getting a return on your investment. In certain instances, depending on who's managing your individual retirement account, you might be getting even a greater return or greater loss in regards to your monthly, weekly, daily contributions. Because but the best thing is with an IRA, you can make a contribution whenever you want to. Great example, I have an IRA with Stash and I have an IRA with Acorn. I make a contribution whenever the heck I want to. I already have the minimum contributions that I make on a monthly basis, but if I decide, hey, I want to throw $100 in there, well, 2 clicks, boom, boom, done. That's the beauty of technology nowadays. And essentially that the IRA is, like I said, it's just another version of a 401k. Tax deferred, growth on investments. You're not supposed to withdraw from it until you're the age of 70, which is kind of crazy. But there are instances where you can do it. Obviously, you have to pay a tax, just like the 401k. But a lot of times people will do the same thing. They'll withdraw money from it for either an emergency or for a business purpose. So it's a individual thing. And there's 2 aspects of IRAs. One, you have a traditional IRA like I have, or you can have a Roth IRA. And the Roth IRA offers opposite tax advantages because that money is actually you pay taxes on that money from those contributions that you make before before you start withdrawing from the pension, from the IRA, individual retirement account. But with a traditional IRA, you only pay taxes on those contributions once you've reached the age of 70 and once you start withdrawing from that money. And you're forced to withdraw from that account by the age of 78 too. You can't just leave it in there. You have to start withdrawing from that IRA account. So that's the difference. Traditional IRA, the money's taxed when you withdraw by the age of 70. Roth IRA, the money is taxed every time you contribute to that specific account. And then another thing is, in order for you to qualify for a Roth IRA, you must make an adjusted gross income of no less than $116,000 or $183,000 if you're married, and if you're as a couple, you're filing jointly. So that's something to think about. And last but not least, you get into, because obviously this whole video is about assets, how you're acquiring specific different assets and how you can utilize those different assets in order to help you grow financially at the end of the day, you and your partner or family, etc. and so forth. And real estate investments, one of the best things to get into. Don't care who you are, don't care what state you live in. If you make your money work for you, this is one of the best ways to make your money work for you. Especially if you live in a metropolitan area like the DMV, you live in Seattle, Portland, New York, Los Angeles, Miami, San Diego, the list goes on and on. But you might live in an expensive market. Okay, here's a crazy thing. If you can afford it, get on a plane, form an LLC in another state, buy in the cheap states like the Carolinas, Pennsylvania, Wisconsin. As long as you know that there's a market of people that not only that have jobs, but if there's a even or a higher ratio of renters, then it's probably in your best favor for you to buy real estate in those specific areas. So if you can end up buying a house for $30,000, $35,000, $40,000 and you get some sort of cash flow, get up to 3 to 5 houses, especially. And then, hey, don't try to do it all on your own. Partner with people. That's one of the best things to do, especially if you know a lot of people. If you got 500 friends on your Facebook friends list, you got to be able to find at least 5 of them that's willing to do something like that. You form a little real estate investment company, and then it benefits everybody. You got tax benefits, especially if you form the LLC, Limited Liability Corporation. You've got tenants, they're paying the loan down. Whatever maintenance you're putting on the place, that's all tax deductible. Anytime you travel to that specific area, that's all tax deductible. And there's just so many different strategies out there and free education out there on the internet that you can utilize in order for you to become a successful real estate investor. So that's my little spiel for today. I think all great pertinent information, and obviously I can get into more later. I have gold up there. Gold is one of those things that it fluctuates. The appreciation of it goes up and down all the time, but I think it is in one's best interest to invest in gold, just to have at least 1 bar or 2 just to bring into your portfolio. But if I was, my advice, not a financial professional, if I was to do that, I would just do that after I've established funds in regards to stocks, bonds, and IRAs, 401ks, the whole nines, and definitely real estate, because that's definitely one of the most pertinent and prominent investments to have. Because even if the stock market crashes and the housing market crashes, it doesn't matter. One thing that's always true about real estate: people are always going to need a place to live, one, unless the economy had collapsed to the point where nobody's got a job, and then 2, there's always going to be an even number or a higher number of renters compared to home owners. So that's why real estate is number 1 on my list, and I hope that it's number 1 on most people's lists for the people that are playing the investment game. So hope you guys liked the video. I know I was reading off to make sure that I got everything right, and I will get more in depth when it comes to bonds, stocks, and 401k later, because there's so many different avenues when it comes to it. I just wanted to give a little a one-on-one version of this, and hope you guys like the video. Please subscribe, please share, and thanks you to all my new people that have actually liked my page and actually subscribed. You guys are awesome, and I definitely will see you in the future. All right, take it easy.